Welcome to Unit 17, and yay, it's the last unit in the fin module. Here we look at joint arrangements and also investments in associates. So this diagram is taken from the intro to units 15 to 17, and you'll see on the left-hand side, this is from IFRS 11, joint arrangements, and we're deciding whether the joint arrangement is either a joint operation or a joint venture. In this unit, we're more focused on joint ventures as they're seen more commonly in practice. And also, the major focus in this unit is where we have investments in associates. So that's where, say, a 40% interest in another entity gives rise to what we call significant influence. So whether it's an investment in an associate or it's an investment where we have joint control and the entity is a joint venture, in both situations what we do is we apply the equity method of accounting. And that takes us to IAS 28 that instructs us on how to apply the equity method of accounting. We apply the equity method of accounting under IAS 28 when the investee is an associate, so where we've got significant influence, or where the investee is a joint venture, so we get here because of IFRS 11, where we've got joint control. So what we're doing is applying what I like to view as an add and adjust approach. So what we're going to do is start with the initial investment that we have for that sort of joint venture or the associate. We're going to start with cost. But to get to the equity carrying amount at each reporting date, what we're going to do is add on to that original cost and make some further adjustments against that. So the way we approach the equity method in the fin module is that we're looking at, like, a parent's got some subsidiaries and it also has, say for example, an investment in an associate or an investment in a joint venture. So the equity accounting entries are made similar to consolidation entries, so they're notional entries. They don't alter the general ledger of either the investor or the investee. So like consolidation entries, the equity accounting entries won't carry forward, and so we need to repeat them from year to year. In taking this add and adjust approach, I like to think of it as I'm just journalising in my share of what I've earned from this associate or joint venture. So remember, the equity accounting entries are going to be recorded when we're preparing the consolidated financial statements. We start with the initial investment at cost and we add on the share of post-acquisition profits and the share of post-acquisition reserves from that company or a joint venture, whatever it might be that we've got our significant influence or joint control over with that joint venture. If there's any goodwill, it's going to be caught up in the initial investment cost. But really importantly, when we look at IAS 28 with the equity method, we don't separately disclose an asset for goodwill. We did that when we were looking at a subsidiary in Unit 16, but not in Unit 17 when we're putting together our equity accounting entries. Any dividends that we've earned from that joint venture or associate, we subtract. And then the sum of those different values is what we call the equity carrying amount of the investment. So we're journalising things on the equity side of our financial statements, share of post-acquisition profits and reserves, taking off dividends. But the debit side comes over to our asset being the equity carrying amount of the investment. So try to think of the equity accounting entries as if we're journalising values into the consolidated financial statements. So here's a bit of an example just to demonstrate what we're trying to do. So there's a 4-year period since the investment was acquired. Let's say it's an investment in an associate where we've got significant influence. So our equity accounting entries need to reflect that there's been 4 years worth of post-acquisition movements in earnings and reserves since X0. So let's focus just on profits. So there's been 3 years that have occurred since acquisition and also the current year. So here, looking at our earnings, what we can see when we prepare our entry at 30 June X4, remember those entries in the past 3 years don't carry forward because we're recognising them at when we're doing all the rest of our consolidation entries. So here our equity accounting entry is showing 3 years worth of post-acquisition earnings against the opening retained earnings account, and the current year amount, our share of the associate's profit after tax for the year, that comes through in that new account name that we introduce in Unit 17 when we're applying the equity method. And so the debit goes to the investment in associate account so that we're increasing the carrying amount of our investment. Here are some other equity accounting issues that you'll be facing. That was a bit fast. So there are some other issues that you'll be looking at, and importantly you'll see that there are tax effect adjustments coming through Unit 17 as well. So, and similarly depreciation and amortization adjustments if we're looking at any fair value adjustments being required.